Hi, Liana. How are you?
Good, thanks. How are you, Mike?
Good. Thanks for coming back on.
Thanks for having me. How have things been?
Things have been interesting. I mean, it's been a pretty roller coaster ride this year. I mean, we knew that the big quantitative funds and the big trend following funds were going to do their maximum buying in July, unless something derailed it, which it didn't. And that's exactly what happened. July was a huge month for markets. And now what's happened is, these quant exposures built up to a maximum kind of in February and then completely unwound to the low in April, basically causing that sell off and then slowly bought back. And as momentum recovered and volatility came down, that triggered more automated buying in a very systematic way that you can kind of predict and literally see in the market. And that culminated in like a huge few months, May, June, and July. But now we're in a situation where that move is behind us. So there won't be any massive systematic quantitative buying. So the Bridgewaters, the CTAs, the trend followers, they're all basically max long now, using like the general models that most of them use. So that move's happened. The one part of the market that didn't move was the discretionary managers. So they're generally about 50th percentile, roughly, give or take, depending on how you measure in terms of exposure. So the quants are max long, but the fundamental managers aren't. And so the question now is, what happens next? I mean, either there'll be a shock, the quants sell again, and we go through the whole cycle, or we just kind of grind higher, and then the fundamental managers slowly start buying back, and you're really seeing this is kind of like a good environment for a fund manager and investor because good ideas are just working. So if you buy a company, it's doing well, it reports well, it's going to outperform. These are kind of like this is like market business as usual markets, and that's quite a relaxing time relative to the opposite where everything just sells off.
How are you approaching things right now after July?
Well, so one good thing about our approach, so we're invested in these high growth companies, but with a quantitative overlay. So we moved all of our almost all our growth stocks to cash, held our biotech, and then late April, May, bought a lot of it back, and then basically almost doubled from the lows. We were down a bit, so now we're up maybe 37, 38% for the calendar year to date. We've kind of made our move. So we made our move, months ago. Now we're sitting on some of those. Some of those went up 2x or more, and we reduced and took some profits. Now you're seeing the laggards start to recover. And the Nasdaq isn't actually up that much. This hasn't been a big blowout year for financial markets. It's really been kind of the speculative end, the small cap end, the growth end. The Nasdaq's up 13%, so it hasn't been a huge year. We've done something like triple that. And to be honest, I feel like we could have probably done better if we got a couple of the winning stocks, winning sectors as well. What we have noticed is what we have been buying recently is software. So we've basically been out of software for a long, long time. Those companies, those companies are hard because some of them, the best ones were extremely richly valued, like your Palantirs and things like that. We're just not going to buy things at 30, 40, 50 times. Obviously Palantir went to 100 times and so has been one of the top performers. Um, but there was a whole, there's hundreds of software companies listed in the United States, and some of those have started to recover, and they're still down quite a lot from where they were a few years ago. And they've been posting pretty solid 20, 30% years ever since. So, there's no guarantee that this is the time that they'll recover. But as it becomes business as usual, as people start looking around for growth opportunities, as they tend to do in kind of the second half of bull markets, I think it's not too surprising you're seeing some big moves. I thought it should be worth looking at. There's a WisdomTree Cloud Computing Fund. So this went up. I can't remember if it was 12 or 16 times, but the Cloud Computing Index was one of the top performing indices that I can remember in, whatever, 15 years in markets, more than 15 years now. But then it peaked at, say, 65, collapsed to mid 20s. So a huge drawdown, that 60, 70% drawdown that a lot of growth stocks and growth managers saw, including us. And now it's recovered, but it's still down almost 50% from the highs. So this is a broad index of growing software companies that's down 50%, 4 years from a peak. And it'll be interesting to see if this time the recovery is sustained. There's been a couple of times it looks like it was going to recover, but it never really did. But the companies themselves have all been growing. You know, a lot of them are growing at 40, 50, 60% in 21. And now those numbers are more like 20, 30. It's very hard to find, actually pretty hard to find a software company growing more than 35, 40% at the moment. Whereas there used to be a whole long list of them. But, you know, it's been quite a few years. So quite a few years of 20, 30% growth. These companies aren't as expensive as they were. So that's like a really interesting part of the market at the moment.
So Datadog is an interesting player in software right now, and they had pretty positive Q2 results. So revenue grew 28% year over year to 827 million. Their operating cash flow was 200 million, free cash flow 165 million. Do you think that's a good indicator of growth for their next quarter?
Yeah, well, I guess this is another one of those companies, right? It was kind of 50, 60% growth rate. Now it's down to 28, but it's been growing at that 20 to 30% rate for, you know, a few years now. There's like a whole, it's almost like a whole cohort of companies like this that were seen as best in class SaaS. Often they had competitors. So Datadog, there's probably 5 or 6 companies in this position, probably more. You know, Datadog has like open source alternatives, cheaper alternatives, but they probably have the best enterprise platform. That comes with a very big enterprise sales team and customer success. So they invest extremely heavily in sales, which is a good and a bad thing. Broadly considered the best for what they do, which is kind of application monitoring. And obviously they build a whole suite of modules around that. But yeah, I mean, this company's a beast. It's got 3.9 bill of cash, positive cash flow, gap negative losses. But if you're growing that SaaS revenue by 28%, I mean 827 million of revenue in the quarter, like this is a huge business. It's clearly extremely valuable. And that growth profitability trade-off probably makes sense at these levels. I guess the challenge with these companies is like the multiples. It's really hard to say what these multiples are worth. You know, if it grows at 28% for the next 10 years, then you could pay an extremely high multiple. But if it grows and then for whatever reason competition comes in and it never actually switches on those profits, then the actual, you know, terminal value or whatever the cash flows they make over the next 20 or 30 years could be much lower than expected. So it's really hard to pinpoint. I mean, one thing you can do is look historically. So this was one of those companies that was trading at 50, 60 times sales, probably more at the peak, and is now down to 12 times, which seems broadly in line with a high quality SaaS business through the cycle. So I wouldn't say it's cheap, but I wouldn't say it's expensive either. In fact, it's probably a decent base case that it stays certainly somewhere between 5 and 15 throughout, you know, its life cycle. I think these are really interesting from a market perspective, though. The fact that they're still down significantly from 2021, the fact that people are looking for growth. I mean, the challenge you've got with all these is if Google's doing EPS growth of 25% and you can value it based on an after-tax multiple, I find it very hard to look at anything that's growing less than big tech companies are growing their earnings. I think there has to be some more juice to it. So the one hesitancy I have with these kinds of companies is that I just don't think they're growing fast enough to significantly outperform. Um, unless you catch one of these big multiple appreciation events. And if you look at software now, there's a lot of companies that are trading, you know, above 20 times, all the way up to the really expensive companies at 100 times. So it's an interesting one. You know, I think this generation of high quality SaaS businesses, from a market timing perspective, I think is interesting. A lot of them are down for the year to date. I think the market participants are looking for that growth, looking for that next wave of companies that will participate in the rally. There's other ones. There's, for example, MongoDB came out with pretty strong results. That's been one of the worst performers, or been a very terrible performer from the highs in 21 and hasn't really recovered. It's still down significantly, but they came out with like a modest result and the stock had a huge rip. So it feels like the market's primed, almost like wants to buy these companies. CrowdStrike's another one that had a pretty interesting sell-off. They had a pretty good result, but maybe they, unlike the others, CrowdStrike did take new highs. So maybe it was just a bit too consensus. Um, yeah, it's hard. I mean, if you think about growth opportunities now, the software, it's hard to find a software company growing more than 30%. It's pretty easy to find something in healthcare. It's also pretty easy to find something in that really spicy end, which is the neoclouds like CoreWeave and companies like that. Like there's one, Nebius, that signed a deal with Microsoft to lease GPUs. And that's probably worth touching on. I mean, why? What is the logic in this? I mean, Microsoft isn't capital constrained. I think that's a key point here. So Microsoft has the capital to buy as many GPUs as they want and the relationships to buy as many GPUs as they want from NVIDIA. I mean, they will be one of the very first in line. So why are they dealing with an outsourced company? There must be some advantage for them. And I guess the advantage they get is that it's like a leasing deal. You know, they basically don't have to bet on the terminal value of those GPUs. They just have to, they have a price, a rental price they'll get to access it, to access the compute. And then whatever happens at the end of the cycle, that residual risk, that risk reward lands on these neoclouds, whether it's Nebius or CoreWeave. So my view has been basically that these companies are extremely risky. They're kind of like they're just leasing commodity supply to a handful of customers. And if the cycle turns, then, or there's a new generation of GPUs that makes the old generation obsolete. Like there's so many ways that the terminal value could be much lower than expected. Then Microsoft will be fine. They'll just stop leasing them. They'll use their own capacity, or they'll buy the new generation, or they've got all the optionality in the world. It's these companies that have taken these GPUs onto their balance sheet and renting them out that will be most at risk. But you know, who's laughing now, right? Like these are huge performers, and these companies are they usually Bitcoin miners or Ethereum miners. The Ethereum miners were most lucky because Ethereum mining used NVIDIA GPUs. The Bitcoin miners generally used custom chips for Bitcoin, ASICs for Bitcoin. So the Bitcoin miners still had an opportunity if they were quick enough to pivot because they had the infrastructure, they had the warehouses, they had the power supply, they had probably some level of engineering talent, infrastructure talent. So they were well positioned to then buy a bunch of NVIDIA GPUs and lease them out. But, you know, the Ethereum miners were even better positioned because they actually had that capacity that they could use. And so that's an interesting part of the market. And I think that's one we're going to watch from the sidelines. I mean, we could potentially play some momentum on it, use our risk models to manage entries, but I don't think we're there at the moment. I think right now they're kind of red hot. It's hard to see a 3x, a 3 to 5x from those companies from here today. I say that they've all had huge increases in value. So I would have said the same thing 6 months ago or 12 months ago. But that's just the way I'm looking at those things. What are any growth opportunities that you've been working on?
Most recently, I've been looking at some really consistent high growth companies over the last like couple of quarters. So Nubank and Mercado Libre. And they seem to be
Classics.
such every quarter revenue increases, growth is relatively stable. Nubank is, I think, a really interesting company, and they continue to expand their products and services every quarter. They seem to be releasing something new. They're consistently growing consumers. So they were originally in Brazil and then Mexico. Now they've expanded pretty decently into Colombia.
Mm.
Let me
And they've
double
still got
check.
the rest of South America as well.
Yes, exactly.
I think the one I found compelling, there were three things there. It was like growing customers, going into new countries, and then growing the revenue per customer. All
Mm-hmm.
that kind of combines to pretty strong growth. Um, the only caveat is it's a credit business, so as a public market investor, you don't really get that much of a look into the credit quality. You can obviously see how something's doing currently, but if people are giving out loans that go bad over the next 5 years, you generally only find that out with time. But you know, this is a mature business now, and they've got a lot of data, and generally the loans are pretty highly priced. It's almost like sometimes the biggest credit risks happen in low risk credit where you're earning 5, 6%, and then you get 5 or 10% default rate can wipe out your profits and eat away your capital. But the really high margin lenders have a bit more of a buffer. I remember seeing a chart that consumer credit, even in the GFC, never had a losing year. So in an actual credit crisis, which we haven't really had since, there's been crises, but they haven't been the same credit. They haven't been credit related in the same way. Even in the worst credit year, high margin consumer credit lending was profitable because those interest rates were so high. So defaults went up, but they still made money because they're charging exorbitant rates. And there was that company we saw in Boston.
The holdings?
That was Propel. Was it Propel? Yeah. And so they're
Yeah.
lending at pretty extremely high rates to consumers, in some cases 100% plus. It's pretty hard for them to lose money. They're making so much money and the turnover is so high. The tenor, like the length of the loan is so short that they've got the flexibility to kind of really adjust their credit and lend small amounts to people. And as they build up, as a customer makes profit and shows they can pay, lend a bit more. Those businesses at least have a huge buffer. But if you're lending out, AAA mortgages in the wrong part of Florida in the wrong time of the cycle, that's when you can get pretty big losses. And those 600K houses are now worth 200. That's when you can get really big losses. A new bank doesn't seem to be like that to me. It seems to be not quite, not quite that predatory 100% lending, but certainly on the higher margin consumer lending, and that comes with really high return on equity as well, which is how that actually plays out into the financials. But that's basically at cycle highs or back at cycle highs. Did it peak? Yeah, it peaked at 12, went all the way down to 3, and now it's back up at 15. Yeah, pretty solid 30% growth numbers and
Yeah,
higher
the
EPS.
Q2 revenue was really positive, grew 40% year over year to 3.7 billion. And they've just reached a new milestone, which is, I believe, 60% of the adult population in Brazil now use Nubank.
Yeah, I mean,
So,
this is getting to that actual seen as a high risk, it certainly was a high risk consumer finance play. And now you're moving into like you're not that high risk, you're actually part of the infrastructure. And I feel like once companies become part of the infrastructure of a consumer economy or a business economy, there's just so many different ways for them to make money out of that. It's such a robust position. There's so much data they'll have on everybody. They probably play on both sides of transactions frequently. They're pretty good. These kinds of fast growing credit businesses are pretty good for our risk managed approach, to be honest. There are actually a couple of others that were red hot stocks in Brazil, notably Stone Co, which for some reason Warren Buffett had a stake in, and PagSeguro, if I'm probably butchering that pronunciation, but PAGS is a ticker. They were complete wipeouts. I mean, let's see, if you pull up their chart, they PAGS peaked at 62 and is now 8, hasn't recovered. And effectively the opportunity, and I look at their sales growth, 0. Profitable, P of 6, but not growing, so nobody's putting a multiple on that. And the core of these businesses was often merchants and payment terminals. But as things move to phones and everybody's effectively Nubank has taken the opportunity that a lot of people were hoping would be captured by StoneCo and PagSeguro. So yeah, it's another one where if you have a risk managed approach, you would have got out of those companies and then had the cash and the capital and the the financial and mental capacity to then invest in the company that did actually succeed, which was Nubank. And that's been winning for a number of years now. We've had that for at least 2 years now, I think, maybe longer.
what else are you looking at in the healthcare space right now?
I bought a company that we owned a while ago called Avadel. So that appeared on our screens for growing at over 100%. And the last numbers were 130% year on year. So it's one of those companies that it works, but it does something that I usually don't like, which is reformulating an existing drug. In this case, it's actually a controlled substance. So it's sodium oxybate for narcolepsy. What Avadel makes is known as GHB. It's apparently used in raves and nightclubs. I'd say it's definitely on the edgier end of the spectrum. It also puts people to sleep. So it's not a drug you really want to have. It's not really a drug you really want to come into contact with unless you need it. But where it is useful is in narcolepsy, when people can't actually sleep, or rather can't really control their sleep at the wrong times. The existing version of it was sold by Jazz Pharmaceuticals very successfully for quite a long time, but the half-life was too short. The half-life is about it ensures that you wake up halfway through the night, and then you have to take a second dose. And so what Avadel did was get a formulation approved that basically lasts the whole night, so a slow release. And this was one of those companies, like, we knew the drug worked. It's obviously an existing drug, so it's well characterized from a chemical and medical perspective. There's obviously a very strong medical logic for having something that you can take once. Like, if you have a drug that helps you sleep, you really want it to last the whole night. Having a drug that you have to wake up halfway through the night and take again is not ideal. And the way we actually originally came onto this wasn't through the growth screen. It was a number of years ago through our biotech specialist, who we used to kind of help us review some of the more complicated biotech plays that we do, Rob Stretch in Boston. He's a sleep specialist, so he was excited and looking forward to the ability to prescribe a one-time or once-a-night use solution for people with narcolepsy. But it's been approved. It was a roller coaster of a stock. I mean, this is one that went from 12 to 1. We owned it during that period. That was part of 2022 in June. Not forgetting that move anytime soon. Yeah, let's have a look. 2022 went up to 11, all the way down to below 1, just basically $1 flat. So a complete wipeout. Bounced back, and now we've just caught it again from, $10 to 15. But now it's pretty much de-risked, significant revenues, growing at 130%. In a market that they'll have a tiny, tiny fraction of their market. But ultimately, I think the medical logic is pretty sound here. Like, I think if you're a doctor, if you're a patient, you're going to want that once a night use. If you have any choice in it, you'll definitely prefer to have something you take once rather than have to wake up in the middle of the night and take again. Like, that's a pretty poor solution for somebody who can't sleep at night. And I think it's just one of
Taking
those like niche little opportunities that we found, and has been pretty profitable to us in the last couple of months.
Yeah, I think taking one dose a night at the beginning of the night instead of waking up in the middle of the night to take two would make such a huge difference on someone's quality of sleep and just overall lifestyle.
Yeah, definitely. It kind of normalizes your lifestyle. But yeah, a very heavily controlled substance. So that's one of the difficulties around it. So if you want to market a drug that's potentially a recreational drug, in this case, it's worse than a recreational drug because it can actually be used to commit crimes,
Hmm.
because it puts people to sleep. It's like about as heavily controlled as you can get. Um, that means the company's under heavy scrutiny. Every dose has to be tracked. There's all kinds of extra regulation and extra monitoring that you have to adhere to. And they're all hurdles that Avadel had to kind of overcome as well. But we don't need to have a view on that anymore, because we can actually see the revenue coming through. So we know people are prescribing it. We know it's in the market and the launch has been successful. Now it's just a case of taking it from tiny penetration to a more significant penetration, and that's pretty straightforward growth play, in my opinion. And it's a $1.5 billion company now as well, so it's quite liquid. We can use our risk management process on it. And yeah, I think that's a little niche company that I don't think we've spoken about before, really.
No, we haven't, but it's really interesting. And if they're able to overcome those hurdles, I can't see why it wouldn't be really successful in the narcolepsy space.
Yeah, absolutely. Well, why don't we wrap up there?
Sounds good. Thanks for having me, Mike.
Thanks for coming back on, Eliana.
All right. Bye.
Bye.